So I've been doing these videos for a few months right now with over 2 undervalued stocks to consider for a specific month, and you guys seem to enjoy them, and I did promise I'm gonna keep doing this video pretty much every month, try to pick 2 undervalued stocks that I believe are undervalued that could potentially be a good buying opportunity for my portfolio or maybe for yours as well, or you could maybe put it on your watch list or something. And we had some great success along the way. We had some quick gainers like, GEO pretty much went 23% in 2 weeks. We had some other great gainers. We did have some losers, but nothing too big, nothing over 5 or 6% loss. So it's been pretty amazing here on the YouTube channel. And in this video, I'm going to discuss 2 new undervalued stocks that I haven't talked about before that I believe are either undervalued or close to fair value. One of them is a dividend stock, and the other one is more of a growing company with a lot of buybacks. I think you guys are really going to enjoy this. But first of all, in this video, I kind of struggled to find these 2 undervalued stocks because I had 2 stocks I wanted to do a video on, and they just moved too quickly and I couldn't put them in the video. The first one, which I talked about before, was actually Sandstorm, and this is a kind of a royalty gold kind of company. They kind of collect royalties from gold miners, and it's an amazing business model. It fell a lot in one day because they were trying to put them out of the index. I believe the GDX index or the GDXJ, but they were trying to kick them out of the gold index, and then they made a mistake. They were not getting kicked out, and the next day it went up 14%, and we made 14% in one day, in my own investment group. The second one was CSV, which I talked about before, and this is a funeral home company, and I was trying to do a video on it. I had the materials ready, I wanted to put the video on, and then there are rumors that it's actually getting acquired, and it went up like 24% in one day, and we sold it for 30% gain. So I couldn't talk about them, and I had to go back and find some other undervalued stocks, but I'm gonna give you these 2 undervalued stocks in this video. And if you're interested in joining my own investment group so you could get more timely updates of when I'm buying or when I'm selling something, or how to do hands-on stock analysis, not just watching some course and trying to do it on your own, you could check out the link in the description below. Now, the first stock that I believe is undervalued and is pretty close to fair value is Ulta Beauty. And I talked about the stock on the channel, but I haven't mentioned it in my 2 undervalued stocks, even though the stock has somewhat recovered and is starting to fill up this gap that it filled before. It could go up after it fills this gap, but I still believe this company is undervalued. And it's an amazing business model for many different reasons. I'm going to talk about it in this video, but most of you are familiar with Ulta Beauty. They have beauty stores in the United States. Women go crazy over Ulta Beauty stores. They make 42% in terms of cosmetics, 21% in hair care, skincare, and sales. But they also have some services where they do, makeup. They do a lot of other things, and this is a growing area of their business, and it's only 3%. And this is something I'm bullish on for the future of the business because they can utilize these physical retail stores to actually do the services that women would do otherwise other places. So I think it's an amazing business model, and it's executing very, very well. They have a lot of brand loyalty. Over 95% of Ulta Beauty sales are from reward members. I mean, people, they just go and shop there and get the points. And this tells you a lot about the loyalty of a business. Normally, it's 50% loyalty members, 60 to 70% with other business, maybe 75%. But 95% of all sales are just from loyal members, people that keep going to Ulta Beauty. This is an amazing business model, and it's something pretty amazing with Ulta Beauty. I really like this business model, and this is a fun fact that most of you don't know about Ulta Beauty is they actually have some AI investments. They have some kind of a fund. It's a venture fund, and they invest in very early venture capital kind of investments. They have some kind of things with AI, some precision lashes, which some robot does some lashes or something. I don't even understand how they do it, but it's just like a call option with the companies, that if these companies tend to become something amazing, and Ulta owns a pretty big stake in all those AI and other kind of things with those companies, I mean, this could be like a call option where it could be a lot of upside with not much downside with this fund from Ulta Beauty. I believe it's a 40 or a 45 million dollar fund. It's called Prisma Ventures, so you can go look it up and check it out if you want. But if we look at the recent earnings report and why Ulta Beauty originally actually fell so much, and I talked about it in my other Ulta video, but one of the reasons why it fell so much was actually mainly because of the comparable sales. The comparable sales, they were 18%, in 2022. Of course, we were just getting out of COVID. It has to be higher. And now it's 9.3% in 2023, which in my opinion was actually very impressive for comparable sales to still be 9.3% even after the huge boom that Ulta Beauty actually experienced. So it wasn't bad at all for me. If you look at the operating income, in terms of margins, it has actually declined. It was from 18.7%. Now it's 16.8% as a percentage of sales, and this is a pretty big decline. It's due to a lot of theft that the company is experiencing. They are having to increase staffing. They're having to put some kind of a security officers in some of their high crime area kind of stores. They're working on getting cabinets to try to lock in the fragrances and a lot of things that the company has that is more valuable, that could be potentially stolen. They are trying to do whatever it takes to contain theft and crime within their own stores, but there's only so much it could do, and it costing them some money, along with a tight labor market which could give workers higher and higher wages, and it's really putting pressure on their operating income in terms of the margins. But I still believe it's 16.8%. It's not bad at all. So I'm not really concerned about that. I think it's gonna eventually improve in the future, and with something like crime, it's not something they can contain. Most retailers like Target are experiencing this, but I believe this is more of a temporary problem, and it will eventually get fixed in the future. Now, the main argument about Ulta Beauty is that it has no moat, it has no competitive advantage. People can shop at Ulta Beauty today, and they can go and shop at, I don't know, some kind of Amazon or some kind of other store tomorrow. But this is actually not true, and Ulta does have some kind of a cult following, some kind of high brand loyalty. People like to go there. They have price points from everywhere. They have the expensive brands, they have the mid brands, they have the cheaper kind of brands. So they have everything anyone could pretty much ask for. And if you could look at their new store openings, they're not closing any stores. I mean, they haven't closed a single store, I believe, in years. So it's not like some kind of company that's closing stores because it's in decline. It's actually opening new stores. They opened 10 stores in 2022, and now they opened 4 stores in 2023. And if you look at the guidance of the outlook for Ulta Beauty, they expect their operating margin to decline further. They had it at 14.7%. Now they have it at 14.5%. Everything else is pretty much unchanged. But this is the main problem with this company right now, is actually the operating margin. Now, if you look at why Ulta Beauty is one of my favorite, kind of business models and the kind of stocks that I like to have, is because if you look at their, shares outstanding, they have been going down pretty much every single year. They do buy back a lot of shares. And this is very, very important because the company has very resilient free cash flow. Every time the stock go down, every time you have some kind of a decline, some kind of a mispricing from the market, Ulta Beauty can come in and can buy back stock. So if you're actually a shareholder of Ulta Beauty, you want the stock to go down. You want the market to not appreciate the value, because the more, Ulta Beauty goes down, the more Ulta Beauty can buy back its own stock, and it can actually create value to you as a shareholder for the very long term. And Ulta Beauty has been good at buying back stock at the right times, and you can see it from their return on capital. The return on capital for Ulta Beauty is over 40% most of the times, except 2020 and 2021, but over 40%. And this is something that's amazing. And makeup and beauty and stuff, yes, they are somewhat cyclical, but they are more resilient than most industries, which could mean that if we have declines in Ulta Beauty stock in the future, the company can take the free cash flow, they can take all the cash they have on the balance sheet, which they do have a lot of cash. They have around $636 million of cash, and they pretty much have no long-term debts. They do have some, operating lease liabilities, just the cost of doing business, but they have nothing crazy on the balance sheet. So they have a good balance sheet, they have a good free cash flow, profile, which means if Ulta Beauty stock experience further drawdowns like it had before, the company can take every single opportunity to take the free cash flow, take everything, and buy back even more stock and create even more value to you as a shareholder. So this is the kind of mentality that I have with these stocks like Ulta Beauty or even AutoZone, that I want the stock to decline, because the cheaper the stock gets on valuation metrics, the more Ulta Beauty can buy, and the more value I get as a shareholder over the long term if you have a very long term horizon with Ulta Beauty. And even after the recent rally in the company, we talked about in the group, it was around 16 times earnings. Now it's sitting at 18 times earnings, but you could see it's still much, much lower than the historical average. It's still trading at close to March 2020 type of levels and pretty close to where it was in the 2008 to 2009, financial crisis. For an amazing business model like Ulta Beauty with tons of buybacks and pretty high returns on capital, I think Ulta Beauty is undervalued at such prices. The mean PE ratio was 27 times, and now it's still sitting at 18 times even after this rally. Now, I'm not saying that if we have a recession or something, Ulta Beauty can't go down further, but then you know what's going to happen. They're going to buy back even more stock, and they're going to create more value to you as a shareholder. So I think it's an amazing business model. I really like this company, and I do believe Ulta Beauty is undervalued. Now, the second stock that I believe is undervalued or close to fair value, and it's more of a longer term type of potential hold, and this is not a stock that I own, I have to admit it, because I own AVB, Avalon Bay Communities, and I'm up over 20% on the position, and I talked about it on YouTube whenever I said in my two stocks to consider video. I talked about it here. I said two undervalued stocks. That was 2 months ago. And I talked about Avalon Bay Communities. But in my opinion, the alternative to Avalon Bay Communities, which actually is a much better company, in my opinion, is actually MAA, and this is Mid-America Apartment Communities. It's a REIT, a real estate investment trust. You can see where the company is sitting at. It's sitting pretty close to where it was pre-COVID, even though rents are much higher than pre-COVID, even though inflation is much higher, which means these apartment complexes are worth much more than they were, pre-COVID, but it's still trading at pre-COVID levels. And the main reason all those REITs are down so much, and I believe they present some kind of an opportunity, is because pretty much every investor is thinking that I can get 5% buying short-term treasuries. Why would I take the risk and buy real estate investment trust? And this is why these kind of stocks are actually coming down. And there's also a lot of other problems with debt issues with a lot of those REITs, which I'm going to discuss with Mid-America apartment communities. But as I said, they do own apartment communities in the United States, but what makes them much different than other kind of places is they have most of their apartments is actually one of the highest growing markets in Florida, in Texas, and in Georgia. They have some in Tennessee, some in Arizona, some in Nevada. So they have them in high growth areas where people are moving to, where the rent is growing. And this is what makes them different from Avalon. Avalon has a lot of properties in California and in New York, and people are moving out of California and New York, and they're moving to Florida and to Texas. And this is where the rent is rising very, very much. And this is why, MAA is actually experiencing very high, rent growth. And you could see in Atlanta, Georgia, the same store NOI is up 12.6%. In Tampa, Florida, 6.9%. Dallas, Texas, 9.7%. These are very high growth areas that MAA is actually invested in. And if you continue and you look at their average pricing growth in terms of the leases, they have been starting to decline a little bit because they've been on a huge run in terms of leases. The new leases are pretty much negative, 50 basis points. The renewals, every time they renew a lease, it's actually 8.6% more expensive than the previous one. The blended is 3.9%. They have over 95.5% occupancy rate. This is a very resilient business model. People have to live somewhere, especially with high interest rates. People can't afford a home, so most of them are renting, and MAA is actually benefiting a lot from what's actually happening. And this is that problem with MAA, and it's not actually a problem, it's actually good. I meant in the entire industry, because the REITs in general, they have problems with that, especially something like, like the hospital REITs and a lot of these kind of companies. But MAA actually doesn't have this problem, because their debt maturity is actually spread out over years and years. It's very well covered within their FFO for the company, and their average interest rate is 3.4%, and it's 100% fixed. So it's not some kind of a variable scam like a lot of these kind of commercial real estate properties have. No, those are locked in 100%, fixed rate at 3.4%, and the company is raising rents 8 and 9%. It's pretty amazing. So I really like what I'm seeing with MAA. It's at one of the highest quality kind of REITs. We look at the shares outstanding, which is very important, because a lot of those REITs, they kind of issue shares to grow their FFO per share. They keep issuing shares to take the proceeds and go and reinvest it. But MAA is actually not doing that, which is why I prefer apartment REITs over other type of REITs. Other REITs even owe realty incomes. They keep diluting shareholders to try to issue shares to take the proceeds and reinvest it. But MAA has pretty much the same shares outstanding they had in 2017, which is another reason why I'm a big fan of this company, and I used to own it in 2018 actually. And if we look at how much we're actually paying for this company, we're paying 18 times FFO per share, adjusted FFO per share, price to adjusted. So it's actually not bad at all, and it's pretty close to aligned on historical average, and it's close to what it was in the March 2020 lows. Now we're sitting at 18 times. The mean was around 18.7, as high at 33 times and as low as 8 times, and this was in the 2008 to 2009 financial crisis. So looking at this chart of the FFO, price to AFFO per share, and if we look at where the dividend yield is actually trading at, which is around 3.8%, higher than the mean of 3.5%, we can see that MAA is actually trading close to fair value. It's not extremely undervalued. It's not a huge bargain, although you could argue that it could be some kind of a bargain because of, the rents are up so much, the property value is up so much, yet the company by itself is still trading at pre-COVID levels with the same pretty much, shares outstanding. So I do believe that, MAA is close to fair value or undervalued for a long-term shareholder, especially dividend investors. The company grows the dividends a lot. It was $2.92 in 2014, and now it's $5.63. So it's growing a lot. I think the company is undervalued. It doesn't mean it can't, go lower. It doesn't mean it's a bargain, but I believe it's somewhere close to fair value. And I believe this is an amazing company to either buy or maybe keep, on your watch list. So this is not financial advice, of course. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.